Welcome to NewYorkBIO's virtual breakfast series, a digital program started in 2020, bringing you fireside chats with leaders from across the healthcare spectrum. This week's episode features the New York Stock Exchange, including Amanda Hindlian, the global head of capital markets, and Luke Brown, director of healthcare capital markets.
All right. Good morning, everyone. Another installment of Working Remotely and bringing you great content from New York Bio. My name is Jennifer Hawksland, and I am the CEO at New York Bio. We're thrilled you're joining us today. We have some amazing leaders from the New York Stock Exchange, and we are very excited to continue our partnership with the NYSE, talking to emerging biotech companies that so far have been leaders in as far as New York companies that are emerging. And this year we are expanding that to also include a session on June 23rd. We hope you'll join us, looking at companies that are emerging biotechs in Europe. So we are thrilled. We're going to talk a little bit about that, a little bit about SPACs, a little bit about biotech listings, and all things finance today. So make sure you put your questions in the Q&A box or the chat feature, and Derek and I will get to them as we roll through the conversation with Luke and Amanda. So Derek, I'll kick it over to you to start our conversation. Thanks.
Awesome, Jennifer. Thanks so much. Amanda, Luke, it is so great to have both of you here. As everyone knows, the public markets play really an integral role in how the innovations of the biotech industry get to patients. Right? It's a major financing tool, and it's really how companies effectively grow up in the biotech industry. So we are very, very excited to be partnering with you again, and we're super excited to have you here this morning. So
thank you for having us.
Well, great. So why don't we kick it off? We tend to do a little bit of an origin story. And since there's two of you, Amanda, why don't you go first? Give us a little bit of background and let us know how you ended up at the stock exchange.
Sure, my pleasure. Well, first of all, as I just said, thank you so much for having us today. It's really a pleasure and an honor for us to partner with you. And all of the folks who are dialed into the Zoom today, thank you so much for joining, and we're looking forward to the dialogue. Again, my name is Amanda Hindlian. I'm the global head of capital markets at the New York Stock Exchange, and I'm actually a relative newcomer to the exchange. So when I talk a little bit about my origin story, you'll pick that up right away. I joined the exchange after almost 20 years at Goldman Sachs. So I did a lot of really cool, really interesting things while I was there, and just loved it and had a great experience. I began my career, well, first of all, I was born and raised in Boston. So for anyone from Boston, I'm with you. And educated there as well. And as soon as I graduated college, I came to New York literally 2 weeks after graduation, no time off. I was packing and moving into my new apartment in downtown Manhattan. And I started my job at Goldman Sachs as an equity research analyst covering semiconductor companies. And I thought I would be there for 2 years, and then I would go on and do something else, like in most sort of analyst programs. But I just fell in love with it. I fell in love with the markets. I fell in love with the clients. I loved the dynamism that it represented. So I ended up staying for 20 years. And over that period of time, I got to do a lot of really neat different things. I was the chief operating officer of global investment research, where I oversaw a 1,200 person business, literally all over the world. We had 25 offices, which was super fun and engaging. I was president of the firm's think tank, the Global Markets Institute, and I got to do a lot of really interesting research on topics that are relevant today to companies, and many companies today are mission driven. And so it was really neat for me to get to spend time with founders and CEOs on topics like gender pay parity, climate change, disruption in markets and how that works. And so even small businesses was a topic that I got to cover, which was really, really fun. I was also a senior strategic advisor in the executive office for a couple of years, where I oversaw the firm's client strategy group. And after this just like amazing, wonderful career, I thought, are the next 10 years going to be like the last 10, where I have all of these opportunities? And I thought maybe it was time for a change. The opportunity to come to the New York Stock Exchange came along, and I jumped at it because it's just a fabulous institution with a really great, wonderful people, and a really interesting forward story that we've yet to tell, that I'm looking forward to help shape.
That's fantastic. And we're looking forward to the forward story as well. So Luke, why don't we kick it over to you?
Thanks. And I echo Amanda's comments. Thanks for having us today. My story is not nearly as impressive, but interesting nonetheless. I started out of school in accountancy. Quickly learned that I did not want to be an accountant. Went back to school, did my MBA at Rollins College, which is in Winter Park, Florida. And like Amanda, I graduated on a Saturday. I moved on Sunday and went to work on Monday. I had a suitcase, had one suit and one change of clothes for about a week before my moving truck got here. I worked for Thomson Financial at the time in a research capacity, which then merged with Reuters, became Thomson Reuters. I then hopped over to a little company called Nasdaq, where I got one of their businesses off the ground in their IR suite. And I was charged with not only getting that business going, but really focusing on healthcare and biotech, because we knew that it was one of the emerging spaces there. Was there about 10 years, sort of leveled off and topped off my career and wanted to learn a bit more. So I went on to the Trout Group, which many people on this call know. It's now Solberry Trout. Wanted to put some more things on my tool belt and did private fundraising, public follow-ons, investor relations at large for larger companies, and was there about 2.5 years. And then I saw an opportunity at the New York Stock Exchange to build a biotech franchise. And I love a challenge, know what I was up against after years not being able to list biotechs for a variety of reasons. But we've got the seeds in the ground now, and we can tell everybody on the call what exactly we're doing here to attract biotechs to the NYSE over the near and long term.
Yeah, well, that's good. And we're going to get to that in a sec, but given your experience at NASDAQ, why don't we just mention a little bit for the audience's edification about why NASDAQ really kind of became the preferred exchange for biotechs? Why wasn't the New York Stock Exchange kind of the preferred exchange all along?
It's a really good question. And I think that history plays a large piece of that, if not all of it. I'll never discredit NASDAQ. They do a wonderful job with their listings, and they were good to me when I was there. However, the small biotech simply didn't qualify for almost the entirety of the history of the New York Stock Exchange. The raises were too small. We had a net income rule, which biotech is completely written out of because they're almost essentially all pre-revenue, unless your name is Genentech.
How much are you supposed to lose to list on the stock exchange? How much money do you have to lose to get there? I think there's
you have to make it.
Yeah.
Then lose it, then you list.
5 years net income positive to qualify, not all that long. Also needed a $700 million market cap and a certain size raise. I'd say about 99.5% of biotech simply didn't qualify. Genentech qualified. But after that, not
eventually they qualified. Not early, they didn't.
No, certainly not. So we went through iterations of rule writing, and we finally got to a place in 2014 after a lot of work to where smaller cap companies could get onto the big board. Our initial focus was on technology, and then we turned our attention toward biotechnology, and we've got a few chess pieces in place. In addition to hiring myself to focus on the private capital markets side, we also had somebody on the listing side hired who's a former sell-sider that will work with publicly traded companies and understand their needs. And then there were a few other pieces that we'll get to in a second that have fallen into place that have really leveled the playing field. And we are open for business now. We have a large tent, and biotechnology companies have started to see that already. We've listed a few. We haven't listed hundreds, but we've listed a few here at the New York Stock Exchange, and I see big things over the near and long term in terms of competition in the space.
Well, bricks tend to be laid one at a time, and we talked a little bit about this when we did the Emerging Company Summit. It was really exciting to see Butterfly Net list. We'll talk about another one of the big listings reasonably shortly, but I wanted to get to the other recent news, which I think is actually really moving. Is the ICE index. And Amanda, maybe we'll kick it to you to talk a little bit about really what that means and what kind of things it puts in place for the exchange going forward.
Sure, absolutely. I'll start and let Luke delve into a little bit of the details. One thing I wanted to say first, though, is just for the audience's sake, I don't know the degree of familiarity with the exchange world, but I think it's kind of important to note that we are not only heavily regulated by the SEC, but we're also an SRO ourselves. So when Luke is talking about the fact that we had to modify our listing requirements to ensure that biotech companies could list with us, the process is it's not onerous, but it's a serious process to go through the SEC and other channels to get approval to modify things like listing requirements. So I just wanted to make sure folks understood that it's not as simple as sort of like an internal approval process, which could have happened much more rapidly. On the ICE Bio point, for a long time, I would say, in addition to all of the things that Luke very rightly touched on as it relates to the different requirements from a listing perspective that the New York Stock Exchange had in place, we were also a bit hamstrung by the fact that Nasdaq had a biotech index, and that in order to be included in that biotech index, you had to be listed with Nasdaq. And what we've done, and it's very recent in the last couple of weeks, it's big news for us at the exchange, and it's one of the reasons why I joined to push this franchise forward. We have now developed our own biotech index called ICE Bio. And our biotech index is still a little bit of a work in progress. It's not, fully there yet, but it's on its way. We've attracted a significant number of assets under management over to our index, which is very substantial. And we, believe it or not, are exchange agnostic. So in our index, we don't actually care whether you're listed with the New York Stock Exchange, Nasdaq, or another exchange, because there are many in the 15 or so in the United States. What we're really concerned about is that the investor who is being exposed to the index has the most liquidity and the most opportunities that the investor can possibly touch. And so we haven't made it so that in order to be a part of the ICE Bio Index, you have to list with the New York Stock Exchange. And I'll remind you that it's called ICE, and because that's our parent company, we're owned by ICE. We really thought more about the totality of investors and what was best for them. What that means is that we have really leveled the playing field so that between the listing advantages that NASDAQ once had and the biotech advantage that NASDAQ once had, we're more evenly playing now in the field so that issuers can really decide what they think the right exchange is for them, without those factors weighing into the decision.
Speaking of decision, can we step back? We can talk a little more details about ICE Bio, but can we step back just a second? Because a lot of our New York Bio member companies are certainly pre-revenue, but even early stage within their life cycle, right? So what should they be thinking about? Now, granted, maybe they're thinking about writing SBIR grants and their Series A, but as they go through the process, how soon should they be even thinking about the public markets?
I have my own opinion. Their advisors may differ in their opinion. My opinion is don't think about it until you're really, really ready. I think that the amount of time and energy spent in going public, which can be really valuable to private companies when they tap the public capital markets, it's a lot, and it's a lot of work. And for earlier stage companies that are thinking about what it is that they're doing, how they're going to grow their entity, what markets they're going to tap, how to expand their client base. I think thinking about going public that early is actually a waste of relatively limited bandwidth in terms of brain cells and time. So I say don't really start thinking about it or focusing on it until you're in your Series C, Series D, and then you want to start thinking about, okay, what might this look like for me in the future? But look, in the early stages of building any business, and we all know that it's really hard. I haven't done it personally, but when I ring the bell with a new issuer, all I can think in my own head, having done research on small businesses, is wow, this is one in a million that not only survived but made it to the point of going public. To put in all of the work that needs to be done to get there, I wouldn't focus on the public market element of it early on. I'd focus on thriving.
Yeah. Can you give us a little bit of kind of behind the scenes on what the conversations around listing look like? How do you actually attract clients? How do you lure clients? What do those meetings look like? because I think for most people, it's probably a black box. We see the, we see the headlines around the Series A financing, we see the deals, and we eventually see, the IPO press release. But I think very few people probably understand how you get from, how you actually get to the point where you pick an exchange and why you do that. So what happens from your side? How do you actually approach a company, and how do you have them think about where they want to go, and what are some of the things you talk to them about?
Luke, why don't you take that?
Why don't we both take it, because we're both going to have opinions. But every single conversation I've had over the last 7 months or so has been different. Every company needs and wants something different, and we're here to do our best to provide those things, whether it's exposure on IPO day and their marketing on day one and beyond, or simply just ensuring that they have access to capital and that they're going to see the investment base that they expect as they move toward public listings. The size of the company tends to vary that conversation just a little bit with the exposure that they need. But some companies want to remain under the radar, which is interesting, because when you see that bell ceremony, the natural inclination is it's a blowout. It's going to be great. We're going to be splashy. But what you don't hear is some companies that, sure, we'll come in, we'll ring the bell, we'll do a couple of media hits, but we don't want to make waves. We can use the New York Stock Exchange for other sorts of things. And that's what we do here, whether it's event space or a big event on day one. That's essentially what we do. But I just reiterate that every conversation I've had, and that's hundreds of them, has been different. And I'm sure Amanda has her opinions as well.
Yeah, I'm probably approaching something like 40 or 50 pitches in the 3 months or so that I've been at the exchange. And it's kind of interesting because the clients come to us, meaning new issuers, via very different channels. Sometimes there's a situation where the issuer is really broadly speculated in the press to be going public. And in those situations, we've usually developed a relationship with the company, 6 to 12 months out of the stage where they're really looking to go public. And that relationship is based on our ability to really protect and treat material non-public information in the way that it needs to be managed. And it's also about our ability to help to really serve as an advisor to those companies, to talk to them about what markets look like, how they're working, what innovations are occurring, what fit may be right for a particular company. So sometimes the engagement with an issuer happens fairly early. Sometimes we'll get pinged by the investment bankers who are involved in a given transaction, and they'll say, this company is going public. Let's both sign an NDA, and then they really want to have a conversation about the exchange. Sometimes it comes in through an advisory firm. Sometimes the referral to the issuer comes in through a general counsel. And there's a lot of different ways that companies choose to connect via the ecosystem to us to decide how it is that, as Luke said, they want to leverage the exchange. And there's a lot of different things that the exchange can do. But fundamentally, at the end of the day, we really view ourselves as client-centric advisors, and we like to be engaged earlier with our issuers as opposed to later, because we have a lot of services and things that we do and provide that can benefit companies well before they're ready to go public, in the year or two before that.
That's exactly right. In fact, Amanda and I actually just worked on one very, very early stage, and I like to speak about specifics just so everybody understands. But I've been working with a company that did a Series A, and they just needed help meeting potential board members. And that is something that we were able to facilitate. And the company is probably 1.5 to 2 years out from even considering an IPO. And we're happy to facilitate that and do our best to help that company out over the long run.
Yeah, we actually have a question here from the audience that I think fits in. It says sort of a question on sustainable competitive advantages in IP, but how does any exchange differentiate or have a sustained difference or advantage over the others? Is it a commodity business, or are there ways to be, as he says, special or better? Is it the trademark or a brand? What would convince a company to list in one or place or the other? And I know some companies, right, that are international have multiple, they're listed in multiple countries, right?
Let me jump off with, that's a really great question. So whoever asked it, thank you. And thank you for flagging it, Jennifer. I think it's a really important question. You know, people do tend to think of exchanges as being commodity-like, meaning that, you know, trading happens across various venues, sometimes in dark pools, sometimes in lit pools. You know, your stock can be issued on the New York Stock Exchange, but trade in a bunch of different places. So there is this sort of general question that comes to mind of, okay, well, what is the differentiating factor? And the reality for us at the New York Stock Exchange is we're very certain that we have a differentiated trading model. And what that means is, unlike any other exchange in the world, we actually, and you can see it in the background for you guys, and it's kind of a shame that you have your, you know, New York Stock Exchange floor photos up and the two NYSE people don't. But you can see in the pictures that, you know, we have an active trading floor, and there's a couple of important elements to that. So, you know, first and foremost, we have unparalleled trading technology, and we've really benefited from being a part of ICE, our parent company, which is fundamentally, at the end of the day, a technology and data-driven entity. So when it comes to the actual trading of shares sort of on a day-to-day basis, and tell me if people's eyes are kind of glossing over on this, but when it comes to the day-to-day trading, you know, really there are a series of algorithms that get put into play. Would we have the best in class algorithmic trading that there possibly can be. So that gives us a little bit of an advantage. But our real differentiating point comes in with the fact that we have a human overlay on the floor. And what that means is that issuers with the New York Stock Exchange will have a designated market maker who they select. That market maker is assigned to them. And that market maker is really active in the issuer's shares at critical break points for the issuer. And I view them in a lot of ways as like a really great, inexpensive insurance policy. Because at your opening auction, when you have a rebalancing, when you're issuing new shares, when there's M&A, you've actually got a market maker sitting on the floor who has unique requirements that only the New York Stock Exchange places on that market maker to be there in your stock, committing capital and ensuring that the order book is moving in an orderly fashion. So that is truly a differentiating factor, our market model. No one else has anything in comparison. Additionally, I would say our brand and our people are really, really strong, and we bring a certain degree of enthusiasm to everything that we do. We are both a really cool mix of really old. We're 229 years old as a business, and I don't call it old the same way I don't call myself old. I say I'm iconic. We're iconic, and yet we also have all of this modern technology that underpins everything that we do. So we're this neat mixture of long history, strong brand duration with all of the modern amenities that you could possibly fathom.
So over the last little bit, you've been, I'll say, fortunate enough to have won some really big deals in the biotech space. And I remember, you know, seeing, you know, David Hong's deal with Nuvation, seeing that and thinking, you know, that's really going to start moving the needle. You see Jonathan Rothberg's Butterfly Net, that's really going to move the needle. And then, you know, recently the Ginkgo Bioworks announcement, which was, you know, pretty tremendous. I think, according to, at least according to Luke, I believe it's the largest biotech listing ever. So what goes into a discussion like that? What does that process look like with a company like that? How do you win business that's that big? Because honestly, you've really started to move the needle on those things. How do you keep winning big deals like this?
That deal was hard, be upfront. It's hard to win a name that is so universally known across the space. And we knew it was going to be competitive. And we won it for partly what Amanda just outlined, was the differentiation of the market. A company that size, and because it is de-SPACing, is going to have a ton of shares outstanding, 1.5 billion roughly, because of that $10 stock price. So there is going to be a ton of shares moving, and they will have the benefit of that designated market maker come de-SPAC time on day one and beyond. We also won it on our tremendous marketing proposal. I give them kudos every single day because we do customize day one proposals for our companies. You don't need to hear the whole pitch. I don't think anybody here is too concerned about that. But we meet with marketing directors at these companies. We understand, or at least attempt to understand, what makes the company tick. What makes each individual founder tick? What can we do for them to give them a New York Stock Exchange experience on day one? And we listened and we took notes and we went to work over the course of an entire weekend, actually, and came back with an amazing proposal on top of our differentiated model and won the business outright. And it was challenging, but we're very proud of that win. And I'm sure you're going to ask about the ticker soon, but we'll get there.
And by the way, Lou, go ahead.
Amanda.
Sorry.
What? No, you're going to say something.
I was going to, as you were talking, I was teeing up the ticker symbol thing, and I was trying to put the appropriate amount of sarcasm and name dropping Brad Longcar. So just without that, so as background, NewYorkBIO's is a synthetic biology company, and I will say that there are probably many synthetic biology companies now that really took notice of that, because it's an industry that could be really disruptive to a lot of things. It has an incredible amount of promise, and has for quite some time. So I think in terms of that entire industry, it's really a bellwether event. So this company now has the ticker symbol DNA, which any biotech historian will know was the original stock ticker symbol for Genentech. And there was a bit of, I don't know if it was an uproar, but maybe a kerfuffle, that may be the right word, over wondering how they actually got that ticker symbol. So do you guys want to give a little bit of insight into the very complex and very detailed way that company got a ticker symbol?
I would love to.
Do we have time? We have time.
Trust me, it's not going to take me long.
We have enough time.
I'll put the hype to rest really quickly. Look, there's symbology plans that are in place by the SEC. We all follow them. So if a ticker is available and a client wants it, we give it to them. The ticker DNA was available, Ginkgo wanted it, and we gave it to them.
That doesn't sound terribly complicated.
Yeah.
All I can
It
do is
wasn't that interesting.
I can
It really wasn't that interesting.
It was totally uninteresting. It literally was, they asked, I kicked it upstairs. They said yes, and then I said yes. I mean, that was pretty much the conversation. That was it.
Yeah, I got an email saying, can we use it? Yeah. It's available, use it.
Yeah.
To be honest, they were probably very excited about it. They probably thought they were going to have to fight a little harder for that, but that's good. Glad to debunk where we can. So, as not quite a transition here, but a continuation. So we've seen a number of deals, including this one, that are these large SPAC deals, and would be good to get both of your insights on really kind of where SPACs have come from. I mean, obviously they're a big deal now, but why did it kind of take so long to become, en vogue? And do you see this as something that's going to continue? Is this going to be a financing mechanism that kind of stays in the toolbox of biotech companies everywhere, or do you see things start to kind of cool down a bit? And both of those things don't have to be mutually exclusive. It can stick around and still cool down a bit.
No, it's a great question. First of all, SPACs meaning blank check companies, have been around since the 90s. Some people say the 70s. I don't really know which one is true. I've tried to do the homework to find out whether it's the 70s or the 90s, but even if we say it's the 90s, they've been around for a prolonged period of time. Certainly there's been a surge in popularity of late, and it's really unprecedented in terms of the volumes that we've seen and the market has seen over both, really in the end of 2019, but then 2020 through to 2021. And the thing I think is really interesting about SPACs is that they're just a unique way of tapping public capital markets. And for a long period of time, sitting on the outside of the exchange, but sitting inside of capital markets at my prior firm, I always thought it was kind of sad that outside of the biotech industry in general, the number of listed companies was declining. And for me, it was kind of a sign that there was something amiss with equity capital markets in the United States, that more companies were choosing to stay private for so long, and the private markets were getting so big, and you were seeing these unicorns that were persistently staying private. And that meant that there was a bit of a less democratization in markets than I think is generally good. So I've been sort of happy to see SPACs as an innovative way for companies to make their way to the public markets. So for me, that's generally been a positive thing, and I think it's good for markets and for companies and for investors in general. Having said that, we did see a slowdown over the last couple of weeks, really maybe 4 to 5 weeks. And that was as a result of the SEC issuing new guidance on a couple of fronts around SPACs. And I think, really looking from their perspective to ensure that all of the guardrails are in place to protect issuers, investors, and the like, and to really protect the integrity of capital markets. That meant that we didn't see as many listings of SPACs over the last several weeks. Now, having said that, those SPACs are still in dialogue with us. They're still working with their accounting firms through some of the advisory guidance that they've gotten through the SEC. Some of them have started to go public. The business combinations associated with SPACs have continued, maybe at a little bit of a slower rate than we might have anticipated, but they're out there. So to put, that was a long-winded answer, but the bottom line is, I don't think they're going away. Could they modify over time? Could the rate at which they come out over time change? In a way, I think it has to, because the rate at which they were unfolding previously felt a little bit unsustainable. But the mechanism itself, the market being there and being a real possible avenue for companies, I think that's here to stay.
Yeah. Well, the initial, go ahead, Jennifer.
I was just gonna say one question. So we've talked about SPACs, we've talked about IPOs. We had a question from the audience, direct listings. So talk to us about like another way to access the public markets that you all provide.
Do you want to take that, Luke?
Well, I'll take a little bit of it. We believe in innovation here at the New York Stock Exchange. So direct listings are not quite as popular as SPACs, but I do think that they are becoming more popular. We've seen a few recently. I believe there's one filed, I'm not sure. But we also innovated with direct listings 2.0, which is the direct listing and the capital raise at the same time. Bypasses the underwriters. It's cheaper, it's quicker, it's a bit easier. I think you'll see more of those, but for larger companies, the ones that have gone out have been Palantir, Coinbase on our friends at Nasdaq, Asana, Slack, and the first one, which was Spotify. I don't know how long it'll take before it gets to mid-sized and smaller sized companies, but I do believe it's on the horizon, and that we are working on marketing to those companies of that size too. I also think it would be beneficial for biotechs to take a look at it, because again, cash burn is name of the game in biotech. And if we can save the company money via direct listing, I think it's something that should be looked at.
We actually had a follow-up question to that one. Is it, it's a layup for you. Is it easier than doing it on Nasdaq?
Yes, 100%. There's no question about that. And actually, we are the ones with a proven track record of doing it successfully across multiple issuers. So of the 8 or 9 or so that have come to market, we've done all but one. And again, this is where our market model is an incredible advantage, because we have the designated market makers sitting there ensuring that the direct listing is pricing and that they're matching bids and offers in a way that reduces volatility for that direct listing. So our model is quite unique. Our ability to manage the trades is also differentiated. Again, I go back to that point around technology. We really truly do have best in class technology. And that's why, the vast majority of issuers have chosen to do their direct listing with us. We also, frankly, pioneered the idea. We were the ones who who we weren't alone, but we sort of took the idea of the direct listing and really pushed forward with it, seeking approval from the SEC and working with companies like Spotify to break the barrier and actually issue the first direct listing. We worked with Spotify for two years or so before they actually did their first direct listing. So, you can imagine from our perspective, we've been at this for a while. And it's an area where our market model is fundamentally a differentiating factor, and it's an area where we have the most expertise.
Agreed 100%. And I have had inbound about that over the last few months of companies just sniffing it out. Is this something I need to consider? You hear about companies dual tracking. What do I want to do? Do I want to aim for the M&A? Do I want to do a traditional? Now SPAC is on the radar. Well, I've had a handful that are now quad tracking, if that's the term. Yeah, it's on their radar.
Yeah.
So what would a biotech company need for a direct listing to be attractive? Would it have to be something? So say, if Moderna wasn't public now, right? Would it need to be something that would have that kind of momentum and recognition in order to simply do the direct listing as opposed to one of the other processes? Would you need that kind of following or that kind of public recognition to be able to pull that off?
Yeah, I think right now, it's not needed, but it certainly helps just because it attracts that you still have to qualify, right? You still need the number of shareholders. You have to reach the price qualification. You still need to meet the New York Stock Exchange metrics. So having that name recognition and the momentum certainly helps. But like we're seeing with direct listings, you start with a household name like Spotify and you can start coming down a little bit. Like Palantir, we know, but I don't think a lot of people on the call actually know what they do. So, so we kind of go down the chain.
Quick quiz.
Yeah. Well,
I think there's probably people at Palantir that don't know what they do.
I think there's people on the call that don't know where the name Palantir comes from. It's actually a Lord of the Rings.
Oh, no, that's not fair. We know what that is.
No, not everybody. It's a Lord of the Rings thing.
Oh, that was going to be a
would
question
say,
we were going to put in the chat, Luke.
I love it. It would be part of our pop quiz. But I do think one thing that's really fundamentally important is just actually having enough volume of secondary shares that you want to list, right? Because, that's fundamentally what you're looking to unlock from a liquidity perspective. It's also why so far it hasn't made sense for the smallest issuers to pursue that path. But I think as companies get bigger, it's not only the name recognition that matters, but it's also the volume of secondary shares that can be sold through the direct listing.
Yeah, Amanda's exactly right. It's eventually these sponsor shareholders need to exit, and if there isn't the volume, they can't access that capital.
Yeah. Back to your you made a couple of comments about the designated market makers, right, and their role on the floor. We actually had a question about how designated market makers can help control volatility, and they use the example of a Robinhood, GameStop. And I also want us to think back to last March and April when trading had to be halted because multiple times over days because of the volatility. So talk to us about how actually having traders on the floor working in these stocks can help smooth that out. Now, granted, luckily we haven't dealt with that level of volatility. It's been a pretty much a steady up, right, for the last several months, but that doesn't mean it's always going to be that way.
So I know the answer to last March pretty well because I've told the story a lot, and then I'll hand to Amanda to talk about GameStop and Robinhood and such. But what they're doing, and we are not going to talk about microstructure of markets at all, but across the landscape of market makers, the market makers are incentivized to step in, but they don't have to. They're also required to have a fairly large spread around the value, the price of the stock. We have different rules on the New York Stock Exchange, and the designated market maker is not only required to be there all day, every single day, but we require them to work in very tight increments, peppering the book above and below. So when something like a global pandemic gets dropped like a bomb on the market a year or so ago, and suddenly your $50 stock is now valued at $25 for no reason, that designated market maker, because they can't step out of the name and is required to work in very tight increments, the orders were filled on the way down. So at the individual security level, they didn't catch halts. the companies can then communicate with their boards about what they're doing to protect their employees. A biotech can communicate with the CRO and say, are our cancer patients still showing up? What they weren't talking about is why they're halted for no good reason. They don't understand why. Because there are situations where the stock catches a limit down halt and you're valued at 20 and suddenly you're valued at 30 10 seconds later, and you're halted and you're stopped for 15 minutes. So just to speak in raw numbers, there were 230 some odd on Nasdaq last March. In that 20-day trading period alone, we had 21, I think, and most of them were in the energy space. For those that remember, there was a negative crude oil day where even the designated market makers were trying to understand what negative $35 oil meant.
Yeah.
So
I wish I had a bunch of.
We'll give you $35. Please take this barrel of crude oil.
Yeah, I mean,
you have to pay someone to take the barrel because storing it costs too much money. So that's what that means. But no one understands it, because crude, like other commodities, are true physical assets. It's not like an equity security that just goes to zero, and that means you're, very likely bankrupt. There isn't that much to say about Robinhood and everything that happened there. People, it's funny, when it actually happened, I got so many phone calls from retired partners who I had worked with historically, from other people who said to me, what does it mean? What do you think it means in terms of regulation? What do you think is changing? And I said, what do you mean? Like, retail investors are allowed to buy stocks. I think it's a good thing for the markets to be democratized. I want retail investors to be able to participate. Do I think adequate disclosures are important? Do I think investor protection is important? Absolutely, all of those things need to be in place. But there's no desire whatsoever, from my perspective, to stop any of the forward momentum of retail investors choosing to partake in the markets, so long as they understand the risks. And I think the "so long as" portion of that comment is incredibly important as a qualifier. But but fundamentally, this is kind of what we want. This is the American dream, and I'm a supporter.
I support it as well. Much like I think everybody on the call understands, and I've always gave this unsolicited advice to every single biotech manager I've ever talked to over the last 16 years, is don't look at your stock every day. You are ultimately going to be valued on whether the technology works or not. And the stock price will take care of itself. So as long as you don't drop the ball at the goal line. But that's eventually what you're going to be valued at. Technology works and you're treating patients, the stock will take care of itself. GameStop is going to be valued on the value of the business. I don't know if it will crash tomorrow. I don't know if it will continue to rise, but eventually it will get to the proper price.
Yep.
Robinhood's business, I don't fully understand. I don't think it's our role to discuss, if selling of order flow is proper or not. That'll be handled by the regulators. That's not really our role. And I really don't have an opinion on it, but GameStop is going to take care of itself.
Yeah, and Luke is making a really important point, which I sometimes refer to as point versus path, which is that, if you fundamentally believe in capital markets like we do, we believe that markets clear, and they clear eventually at the appropriate value for a given security. It doesn't mean that your path to getting there is necessarily always even. You can have some volatility in the path, but the point should be the point regardless over time that reflects the value of the entity. So you kind of have to think about it in that way, even though time periods make it hard to. Sometimes when you're dealing with that volatility, it's harder to deal with from a day-to-day perspective. But over time, if the value is there, the value will be reflected in the market.
Exactly.
Yeah, I have one more question. So we've talked about being on the floor, and I think it was the beginning of July, we had Stacey Cunningham as our guest on our same breakfast series. And at that point, you really didn't have folks back on the floor, right? And because of COVID. And so talk to us about where you are in that process and getting the floor back up and running, and what that does for your issuers.
Sure. I mean, so there's a couple interesting points there. The first one is there was an independent academic study that was done during the period of time where our trading floor was closed. And it was a really interesting finding because essentially what they found was that stocks trade better when the trading floor of the New York Stock Exchange is open, better than when it's closed, and better than the Nasdaq. That's just, fundamentally what they found in the study. But even without the designated market makers on the floor, we still performed better than Nasdaq. So it's kind of interesting to see the boost that the market makers provide in general, but also that there's enough of a spread in performance between us and the competitor that we tend to do well even without those market makers on the floor. It wasn't an experiment we would have chosen to run. It was forced upon us, but it was an interesting one to kind of uncover nevertheless. And Stacey's very clear about that, and I think she articulates it really well. Right now, the exchange is opening up. So, we have more and more people on a weekly basis coming into the building. We have more people in their offices. We have more people on the trading floor. We're probably approaching, 25, 30% of our normal people capacity on the trading floor. I only see that going up from here. And it's kind of fun from my perspective because we have so many conversations with issuers, and right now they're dying to come into the building and in big droves. So we had our first 100-person listing day activation last week. We have many more of those to come and in even bigger sizes. So I think as people get vaccinated, as they become more comfortable around being in public, the masks are sort of, very slowly and carefully coming off, and people are very slowly and carefully coming back out into both the building itself and and the trading floor.
Yeah, we since we switched to virtual for our December emerging company showcase, all of our New York Bio community missed the trading floor reception. We're hopeful that by the end of 2021, that could be a reality again.
Oh, we would love to have you, and maybe it's as soon as the fall. So you don't know, and we would love to host you and have you back. I think it's an optimistic point for all of us, and I like to harp on optimism because we've all been through a tough time, and it's been a really tough, challenging environment for a lot of people. It's nice to kind of see things normalize. The irony is that I'm actually usually in the office every single day. Today, I'm actually from home for various extenuating circumstances. So normally you would see the New York Stock Exchange behind me.
I've been rotating back and forth. I was there on Friday.
Well, so we have our annual meeting coming up on September 27th, and we kind of look at it as an opportunity to basically bring people together in person, to actually really lean into kind of what it means to go back to a meeting in person. Why is that valuable, and how can we do that for our community? Obviously within certain guidelines, but we've been talking a lot about that, and certainly as probably one of the earlier biotech events in the fall, we really kind of relish the opportunity to kind of get a great meeting on the board and give people a lot of hope for really good things to come.
That's great. And you might find that there's a lot of hugging, a lot more than you would have anticipated, that people are really, really, really happy to be back together. And there's nothing quite like the human interaction, the face-to-face and the handshake. So I mean, I love the virtual worlds. Don't get me wrong. I don't miss commuting. Having said that, in person is really, it's special now. It is.
Yeah, it is. Yep, I think it is, and I think it'll continue to be. So I think we have two more things to hit. So Luke, I'm going to throw this one to you because we had our own patient engagement summit earlier in the spring. And patient advocacy and access programs have become really important in a number of fields, especially where patients have chronic conditions. So can you speak a little bit to the role that patients could potentially play in providing context for a public company? The question here was, is there value in a company having something called a chief patient officer, or are there examples of companies that have done a really good job with patient engagement and their strategy around going public?
interesting question and not something I've
Yeah,
put a
it was really
ton
good.
of thought. Yeah, it's a really good one.
I didn't
don't
know that existed, but it sounds like a great idea to me with no knowledge, no research, just
I
sounds like the
think
right thing to do.
I mean, here to that. I haven't heard a lot about it, but yes, I think it would help. Look, let's be frank. In my previous role, when I was doing private fundraising, there were cringe moments where companies were, they started addressing things like addressable markets and how much money we can make and so on and so forth. And right, that's the name of the game. This is American capitalism. But behind all that were patients, sick patients. And I have a heart. And I ran into a few times where I was wondering whether senior management cared or not. And I'm sure they did, but how much did they care? Having somebody like a Jonathan Rothberg, and I know that we're all connected to him because he did that panel back in December, whose primary motivation is solving problems for loved ones. It's right on his website. It's been the start of every single one of his companies. That's a long way of saying yes. Having an empowered chief patient officer, I think, would be huge for the space to ensure that they continue to focus on the well-being of the patients at the companies. I know that a lot of CEOs get involved in biotechnology because they've either lost somebody or they're a survivor themselves. Yeah, but not everybody has. They're just an experienced manager. And I think having somebody on board would be huge for a company like that. Yeah, without putting a ton of thought into it, just because I didn't know. But yes, I think it would be tremendous for a biotech to empower someone to think about the patients and their well-being. And I also think that company would be a winner in my book, and I would invest in it. Just seeing that person and meeting with them.
And if you
And,
think
and
about,
honestly, again, with very little, you're not supposed to speak with no knowledge, but I'll do it nevertheless, because why not? It's fun. And, that's what we're here for. But I also think it could be really interesting from the perspective of ensuring that you're touching a broad enough category of types of people as patients. Because, we do hear sometimes that studies were geared towards a 200-pound man. And didn't actually consider other demographics. And if you had somebody who was really responsible for trying to ensure that, a particular drug or a particular technology was being deployed across a broader swath of the population, that could be a really interesting element of the job as well.
yeah, and think about, the way I would think about it is also when you have a company that's, I'm not talking about a Merck or a Pfizer, I'm talking about more rare disease companies. It's the public, the listing a company is a victory as much for those patients that have waited for treatments and cures as it is for the executives.
Mm-hmm.
Yeah.
It is very much.
Well, this is something that's been, that we've seen a lot more of lately. We're working a lot more of this into our programming. And I think, we're fortunate that there are a number of folks within the industry that are true leaders on this front. So it's my hope that it becomes much, much more visible. And I hope it becomes much more commonplace. So Amanda,
well, I appreciate it because we'll be advocating for that with our new issuers, right?
Yeah.
We'll be suggesting this to them as something that is a positive thing for them to do.
But I can only quickly add that the silver lining to COVID, and there have been a few, is that the general population has seen the importance of healthcare and what we can get done in a relatively, well, not even relatively, in an exceedingly quick amount of time. It bears repeating. Everybody here on the call knows it, but we got vaccines on the market in 9 months using new technology, and we're reaching the globe. It's unheard of. Roll back the clock to polio. It's forever. So, here we are, we did it. And now everybody knows that when investors and monsters like Pfizer open up their checkbook and put their heads down and put everybody with a white coat onto the project, we can get it done really quickly and save lives. We did it.
Yeah.
And
I would have picked a different word than monsters there, but yeah, totally.
And one
big company.
I know what you meant. Just clarify.
A silver lining too is the increased interest. I know my ninth grader, like in last year, took a online epidemiology course from like UNC Chapel Hill, right? Because he was just trying to he was reading the newspaper and trying to figure it out. And so I think my hope is that we'll also have students that might not have traditionally either had access or an interest in going into sciences choose that path going forward, and particularly minorities and women. And so, Amanda, I know you've done some work around supporting the gender gap in business. Can you talk to us a little bit about that?
Sure, absolutely. It's a real passion of mine. The importance, I think, of having a level playing field for all different types of people in whatever it is that they do. And so I chose to do research where me and my team, and actually it was a team of all female authors, which was coincidental, not on purpose, but it was fun that it turned out that way. We looked at gender pay parity gaps and really tried to understand why the gaps arose. And, we could find that, and this was pre-COVID, on a, like for like basis, that a woman is earning, 80 cents on the dollar compared to a man. And that's for controlling for as many factors as you can based on data that are available in the census. So when you look at that, you say, that's not fair. And when you generally see a lack of fairness, it certainly makes me want to get involved. It certainly makes me want to be vocal. And we saw it in life sciences, and we saw it with the lack of women coming up in the scientific field. Now, fortunately, I think that's become more of a focus over the last couple of years. I am concerned that in a lot of ways, COVID has set the diverse and female workforce back a bit. And one of the things that has, and I hate saying it because it sounds incredibly sexist, but it's just factually true. One of the things that's historically been true when you look at the data is that women bear the disproportionate burden of work at home. That's not in every relationship or situation, but in general, when you look at the data, women not only do more work at home, more work related to childcare, but they also tend to do work that is repetitive, meaning it tends to have to happen daily. Where men pop up and start doing the work at home is like on the weekends. Where it's less likely to sort of interfere with work for them. And I think that's a social dynamic that's changing with this generation and changing over time, that's going to be net beneficial. But we certainly, in a post-pandemic world, which is the world I hope we're going into, notwithstanding challenges in other parts of the country, of the world, I think we really have to focus on the fact that because women are bearing that disproportionate burden of work at home, and they tend to get paid less for the same work, it made sense for women to withdraw from the workforce during COVID to take care of their families. We shouldn't have it make economic sense for one type of person to withdraw from the workforce. It should be an even level playing field. And so that's something that, I will always be focused on over the course of my career, promoting diversity and inclusion, promoting gender equality. And it's not about anything other than an even playing field.
That's great. And we hope that you'll continue to engage with us, but also New York Bio is hosting a cross-functional, cross-industry equity, diversity, and inclusion, looking at increasing those metrics within our New York life sciences ecosystem. So maybe we'll tap you from some of your research and your learnings.
I'd love to do it.
Both so much for being our guest today. We are very much looking forward to our emerging company showcase on the 23rd with the New York Stock Exchange. Amanda and Luke, we appreciate your time, your insight, and your generosity in sharing with our audience. So thank you very much.
Thank you.
Bye,
guys.
Thanks so much, everybody. Have a great day.
Be well.
Thank you for tuning in to New York Bio's virtual breakfast series. Join us every Tuesday at 9 a.m. for more discussions with leaders from across the healthcare spectrum. For more information on New York Bio, please visit us at www.newyorkbio.org.